Stock market is just shot up. It's up over 8% this morning. Just joking. Happy April Fools. But markets are actually down again this morning. If we take a look at the markets, we've got the SP 500 down about 0.5%, the NASDAQ down about 0.4%. Overall, market kind of had that bounce over the past couple of weeks. It sold back down. And on Friday, we had this really weak close. If we take a look at the sell-off on Friday, the market sold down, refused to get any traction, closed near the lows of the day. We talked about this last week that if the market closes on the low, we're going to see that fear carry over. It's going to percolate in people's brains, increase the fear, and then Monday we should see some type of gap down, some type of sell-off, and that could be that exhaustion gap on the chart, which we saw massive panic selling. We even saw the VIX spike way up into up almost to 25, telling us that everybody was panicking out. And on top of that, we saw the put-call ratio spike yesterday at the open way up over 1, telling us everybody's just buying put options. So we saw that extreme move. It was a pretty high probability play. Really, we saw early morning selling of everybody just dumping everything they could. And then the market took off and screamed the opposite way. And there is a ton of frustration in the markets from yesterday's price action with the average Joe who just don't understand the markets, who are trading on emotions, literally panicking out at the low, and then the market takes off and they get the worst possible fill, which is right down here after the market opened. It's hard to see here. Market opens. Everybody hits the sell order. They panic out, hoping there's going to be a rebound. They can't take it for the first half an hour, and they're like, okay, get me out. And then as soon as they all finish getting out, buyers step in, and the market rebounds and has a pretty strong reversal. Like from the low yesterday to the high, the market rallied 2.5% on the SP 500. If we were to look at that same time frame here on the NASDAQ, the market rallied 2.75%. So again, huge volatility. When we look at the daily chart, you can see here this looks like a short-term reversal bar that the market's going to want to potentially go higher. A huge gap down, a flush out, and then rebound. Usually we're going to see the markets want to try and push higher for a day or two. So we'll see if this momentum carries over. Now keep in mind there are a bunch of mixed signals, and I kind of regret starting to show the cycle analysis because everybody just naturally, if you give them an inch, they take a yard or a meter, and they want to just take any trade that looks like a setup. And if we go back and we look at the cycle chart, you can see here our cycle bias is pointing to an upward bias. We've got these longer term cycles pushing up over the next really couple of months that can drag this cycle out further. Overall, we got a whole bunch of short-term cycles already starting to pull down. We've got a few more cycles, it's hard to see here, starting to move down. But overall, the bias is to the upside. It doesn't mean price has to go up. And so while cycles point to higher pricing, our trend analysis is clearly down. We don't want to be holding stocks. You can see here on our 30-minute chart, it is saying, sell short, or market's overbought, get ready for more selling, and that's what's happening here. And so when this is the problem with too many indicators and using different types of analysis and following other people's opinions, and analysis is simply because one person will be saying, hey, there's a bullish bias, the market is oversold, and it is oversold and ready for a bounce, but the trend is down. And if we take a look here, we've got these red bars. We talked about this when we were starting to get into this red bar over here, saying we're having a cluster of cycle lows. We're not out of that yet. The market is still trying to find a bottom. And until we get green bars, that's when the cycle has actually bottomed. And so an indicator, if you're looking at future price action and trying to front run things and pick bottoms, that's where you get into trouble. The cycles haven't finished clustering. The overall bias is still negative because there's longer term cycles. These longer ones here are still pulling down, and longer term cycles have way more power than these little short ones. So that is the big confusion, and I kind of apologize for even bringing the cycle stuff in because I love it. It is interesting, but we don't trade off it. And as soon as I share some insights that show potential to make money, a lot of you jump ship and instantly have to take advantage of it. I know a lot of you got into leverage ETFs anticipating this to go higher, and I do think this market is still most likely going to have a big bounce over the next couple of months. The question is this the start of the bounce, or are we going to have the second half of this leg to the downside first and then we go into a bounce and pretty much come back to where we are right now before it, I think, rolls over and goes further down. So again, bullish bias with one indicator. Our short-term momentum says it's down. You don't want to mess with it. If we look at the NASDAQ, you can see we have clearly a exit signal. The trend is down, and while it looks oversold and ready for a bounce, you know, trying to pick a bottom is a very dangerous game. So hopefully that shares a little bit of insight of kind of why analysis paralysis, watching too many things and using other people's opinions and weaving in other analysis can really throw off your game. And that's probably more my fault. Less is more, and that's the whole point of ACS, is like the less we trade, the less we, you know, dive into all the nitty gritty, the less mistakes and less things people will try to do, because everybody naturally wants to trade. It's highly addicting. We all like trading, but the more you trade, the more you lose generally. And it's really, we just want to catch these waves in the market and not try to play the noise and get sophisticated here and try to outsmart the market by getting in position before it actually even turns around. All right, so let's go and take a look where money's flowing today. So it is flowing out of stocks. We are seeing money moving into bonds. We have bonds up 1.1% this morning, so they are continuing to extend and push higher. So while the stock market has that bearish price action, the bond market actually has a bullish price action. Now, all the key moving averages are more or less sloping down. This is pointing to potentially a move going higher. Of course, if bonds go higher, that probably means we're going to see interest rates go down. So let's take a look at the 10-year note. You can see here it's got the exact opposite of the bond chart. It's got a downtrend. It has a bearish price action, and looks like rates might want to continue to go lower. If rates go lower, we're probably going to run into some economic issues, and the Fed might cut rates, and that will send bonds higher. So that's kind of the pattern that we have unfolding there. Now, if we take a look at, we are seeing the dollar move up a little bit today. It's trying to carve out a bottom here. We have gold and silver up about 0.4% today. Again, gold's just in favor. This is like really is a no-brainer. We've been talking about this for a long time, that gold is in an uptrend. You don't want to pick a bet against it. It has hit all of our targets. We've had our targets here at 2750. We've had our target right up here. Where else do we have our target? I think we had a 618 target. We had another target here. Our next target is at 2732.75, somewhere up here. So there's, again, once we have this analysis, we can only really map out kind of generally one or two legs forward at a time. And so the next leg is here. And of course, if the trend is up, you either want to be long it or you definitely don't want to bet against it. It's the same as a falling stock market. If it's going down, you don't want to try and buy something. A lot of people are saying the markets are once like a huge buying opportunity and we're going higher. It'll be very interesting to see how all this plays out. But gold is in this feeding frenzy where people are piling in. It's drifting higher. They don't know where to go, but they are moving into commodities. And our hot list definitely makes this pretty clear. If you look at the top of the hot list, what are in kind of a bullish phase and short-term uptrends, really it is commodity resource stocks based around the precious metal space and energy. We have bonds, we have consumer staples, we have utilities, and we have real estate. All of those things are what the commodity ones tend to do well when we're at the end of a major bull market. Gold tends to do well, and silver will follow up, and the stocks will group. Energy tends to do well because there's uncertainty and war and all kinds of stuff going on. And then bonds, people naturally move to bonds if the economy is getting weak and they don't know what to do. They move to safety. And rates generally are going to start to get cut if the economy gets weak, which we have earnings seasons just around the corner. It'll be very interesting to see how earnings season plays out. If people are missing targets and downgrading, their future revenue ideas. And then there's real estate. Almost all of us investors own at least one piece of real estate. And it's usually a big chunk of our portfolio, of our wealth. And when people get nervous, they move to real estate as like, I'm just going to buy a REIT. Although, just keep in mind, REITs are very dangerous. These do not move like real estate. A REIT will fall 60, 70% during a financial crisis, at which point they are a screaming buy. The dividends are huge, lots of upside potential, but they will not protect you. The only reason we see real estate do well is just because the masses don't know what else to do, and they naturally just move to a REIT thinking real estate's stable. But again, REITs are not stable. They move just like a stock. You can see here in 2022, we had a little baby bear market, far from a big recession. You know, it fell 37%. We saw, and during COVID, we saw REITs fall 43%. I don't think this chart won't go back far enough to 2008, but you can lose your shirt holding REITs. They are not safe. They are a stock. They are very dangerous. There's a good time to buy everything, and holding a REIT during a recession is not a good time to hold it. But after a recession, it's a screaming buy, an easy way to get into real estate. You don't have to do the legal work. You don't have to buy properties. You can buy a bunch of different REITs and self-storage and commercial or mixed, whatever you want. And it pays a very nice dividend, and you can get in and out of it with $1, $100, 100,000, million, whatever you want with a click of a button without any real transaction fees. All right, other than that, let's take a look at this. This is something I just kind of looked at this morning. I think what I want to show here is how the bottom one is the 60-40 portfolio. We have gone from 2021 to now, still underwater. The buy and hold, that is a long time. A lot of people are just starting to realize how the buy and hold strategy is very painful. We've gone over 3 years with no returns. You're actually down about 5 or 6% right now. The buy and hold is down about 10%. The stock market, if you rotate from asset to asset like what we do, you can see how the stock market is down about 8%. But since the high back in 2021, the stock market is still up about 16.5%. So it just shows how the buy and hold portfolio dramatically underperforms. 3 years, we haven't even started a bear market really yet, and you're already going on 3 years with no returns and you're down. That's how painful this is. And when we do have a financial reset, it's going to get real ugly. And that's the whole reason why we're here and how we avoid all this with our ACS, our strategies, following price and managing positions, managing our risk going forward. So other than that, that is about it for today. We will see how the markets unfold and go from there. Take care. Bye-bye.